Hey, do you have a term life insurance policy? Because in this video, I'm going to share what I love and hate about term life insurance in Canada. And you might be surprised that you could end up overpaying even though it's just a term life insurance. Hey, this is Thomas. We have the most Vancouver life insurance 5-star Google reviews, and this channel is to help Canadians build tax-free wealth for their retirement and to protect you and your family using solutions that Canadian banks don't want you to know about. So enjoy what I have for you, and let's get started. Let's start off by determining what term life insurance actually is. It's a type of life insurance policy that offers coverage for a specified period, usually in 10, 20 or 30 years, and during those time frames, it is to offer a tax-free money to the beneficiaries in case one passes away, so they can use it to pay off the debts, fund children's education, or to provide a consistent income. And similar to auto insurance, if there's no claim during those periods, the term insurance will expire. If you still like to have the same protections, you might choose to renew the policy without any medical checkup, meaning you're guaranteed cover regardless of your health. So, who is term life insurance for? There are mainly two groups of people. The first group of people is mainly have cash flow issue. They just want the lowest cost with the highest coverage temporary, so term life insurance will be a great option. The second group is really great for people who need coverage due to the financial liabilities and they know this kind of liabilities will be gone in a certain period of time. For example, a young couple with a mortgage or family with young children, they will make sure the family will not be financially devastated in case of an untimely death. And besides from a personal aspect, business owners should pay attention to it too. Imagine Tom is your business partner and he's the CEO in your small business who is really critical to the success of this company. If something happened to him, it would be really challenging to replace whatever it is he to bring to the business. Therefore, the company you can take out a policy against him. Term life insurance may be a great option if the business is going through a critical period, like maybe they are growing rapidly or Tom plans to retire in the next 15 to 20 years. So if Tom passes away unexpectedly, the business gets the death benefit and they can use that to offset the loss of that key person. Another example of how a business can benefit is with the buy-sell agreements. Basically, when Tom passes away, his share in the company will go to his wife, Jane. Jane has no interest in running the business, so she asks you to buy out her shares. Well, the question is, the company has no extra cash. Therefore, in this case, if there's a life insurance proceed, then problem solved. You get the full control of the company, Jane gets the cash and move on, win-win situation. And in the future, I will share more about the key person insurance and the buy-sell agreements. Just comment below. So how much is a term life insurance then? Term life insurance is much lower cost compared to the other major type of life insurance option available, which is permanent life insurance at the initial stage. The reason this is the case is, of course, that permanent insurance covers you for your entire life if you keep paying your premium, and where term life insurance is just a set period of time. Let's look at an example. Peter is a 35-year-old non-smoker male and he knows he needs $500,000 insurance coverage. Now for a term 20, a $500,000 term life insurance will be around $25 to $40 a month depending on which insurance company he applies. In contrast, a permanent life insurance policy with the same death benefit might cost him around $250 per month. Seems like a no-brainer, right? Why would you pay $250 a month when you can only have to pay $30? So here comes the part where I love and hate about term life insurance. For sure, if Peter's financial objective is mortgage only, it seems like having the term insurance will be a much smarter choice. However, that is just half of the picture, and two problems arise in the later picture. One, according to Statistics Canada, even back in 2019, at least 1 in 5 Canadians who is age 65 or older still have a mortgage going. And I'm sure due to the pandemic and the recent interest rate hikes, many more Canadians who is age 65 and above will still have debt payment. And second, Peter is only age 35. Most likely he will upgrade his house or he will refinance his house again for another financial objectives. In short, most likely Peter still needs the same insurance coverage when he turns 55. And let's take a look on how much a term life insurance is going to be at age 55. Again, right now he's paying around $30 a month for the next 20 years, and after 20 years, Peter needs to pay $600 a month if he decides to renew the policy for another 20 years until he reaches age 75. So in those 40 years, he'll pay a total of $150,000 for a $500,000 coverage that only covers the what if. And I still haven't covered the other financial aspects like the final taxes on his RSP, probate fees, or maybe he wants to leave some money for his kids. And unfortunately, even you have the money, almost all term life insurance in Canada expire at the age of 80 to age 85. Let's say if Peter can afford $250 a month, what kind of benefits he gets in return from a permanent life insurance? First off, the coverage will be still minimum of $500,000, but now the duration is for life, meaning Peter doesn't have to worry about any huge price jumps and his life insurance is a guaranteed payout. 2. $250 a month is $3,000 a year, so Peter will pay $120,000 for the next 40 years. And in return, he gets around $750,000 in coverage at age 75 instead of $500,000 because for most of the permanent life insurance, the coverage increases as the time goes on. So Peter is really paying less dollars for a higher coverage. And third, again, if planned well, those permanent life insurance should contain a saving portion, meaning Peter can access that money alive to fund his other financial goals like retirement, car purchase, or extra boost to his tax-free saving and RSP. So going back to that $25 policy, yes, it's way cheaper than a permanent life insurance policy initially, and yes, Peter should still have a term life insurance policy if his budget is tight. But just be aware, it is designed to provide a short-term protection only and you need to have a backup plan. If not, you might end up paying a higher premium after and leave you with no options. Hey, don't get me wrong, I love term life insurance. I think it's a great product and I believe every Canadian should have it just in case of anything. Unfortunately, I do think some life insurance agents won't accurately explain the drawback of term insurance. Because term insurance is so easy to explain and understand, the insurance advisor can look at the term insurance as an easy sell. But to me, any form of life insurance is more than just a product. It should be implemented into your financial planning. So how do you get the right term life insurance? And before any recommendation can be made, the insurance advisor and the client must need to have a much deeper conversation. Understanding the client's both personal situation and goals financially, and this is exactly why it's much more in-depth than just a coverage and a quote. And to simplify a little, just like Diamond, I created a 4C grading method to guide you through what type of life insurance that fits you. The first C is coverage. How much life insurance coverage do you need? Second is cash flow. How much should you allocate each month for this coverage? Third is customization. After deciding the first C and second C, then we determine do we want term, permanent, saving, or guaranteed payout, etc. and etc. And the last C is company. Which life insurance company should you go for? I have a full video that talks about it, so be sure to check it out. Oh, and for the record, 99% of the time, I almost never recommend a term 10-year policy unless there are some specific circumstances to consider. It's much better to get a term 25 or even 30-year. It could be just $10 or $20 more, but that way you don't have to worry about your policy increasing for at least the length of your term. Also, if your term insurance policy is about to expire, please make sure you contact your advisor so you get to know your options. Your finance is much different compared to 10 or 20 years ago, so a lot of things has changed. For example, you might want to renew your life insurance policy earlier so you can pay a lower price than renewing it later. Or if you have certain medical conditions, you might consider converting your term policy into a permanent one so it's a guaranteed policy will pay out. Any options will be at least 10 times better than doing nothing on it. And if your advisors retire missing, feel free to contact me and my team. We do free policy reviews and we have access to at least 10 major insurance companies, and we are confident in finding the right solution for you. And I will leave my contact below. That's basically what I have for you in this video. Let me know how I do, or if you find this video is useful, please send it to your friends and family. This is Thomas. Thanks so much for watching, and I'll see you in the next video.